Okay, hi there. Welcome to a macro video. The concept of monetary financing is covered in this short revision video. So monetary financing has become more prominent as a possible macroeconomic policy as the COVID-19 crisis has engulfed so many countries, including the UK. The British government, for example, has seen their spending surge, including the billions spent on the job protection scheme, whilst at the same time tax revenues have dropped away quite sharply. And the result has been a dramatic increase in government borrowing. According to this article from the Financial Times, the UK has become the first advanced country effectively to embrace the monetary financing of government to fund the state's spending needs on a temporary basis. So what is monetary financing? Well, it's best defined as a direct transfer of money from a central bank for a government to spend. And this might involve the direct purchasing of new government debt or bonds by the central bank. Monetary financing does differ from quantitative easing, which you may well have come across, QE, as a monetary policy used by many central banks in recent years. So how does monetary finance differ from quantitative easing? Well, it's not quantitative easing. That is where a central bank goes into the existing secondary market for bonds after they've been issued and makes a bond purchase. So a government might have issued some 10-year debt, for example, 3 or 4 years ago, and the central bank goes in and buys up existing government debt which is available for sale in the secondary market, and that money of course then injects some cash, some liquidity into the commercial banking system. Monetary financing is the direct purchase of new debt issued by the government, and QE is not meant to be a permanent feature of monetary policy, whereas monetary financing is the creation of permanent central bank money. That said, the UK government has not yet repaid any of the bonds that it has purchased. The rise in national debt is a feature of many countries. UK national debt rose to nearly £2 trillion, or 101% of the national output of a country, exceeding the size of the UK economy for the first time since 1963, in part because VAT revenues have collapsed. Now, normally, when a government issues new debt, it issues it to the capital market, and typically the buyers of that debt include sovereign wealth funds, hedge funds, the big pension fund investment managers, high net worth individuals, and insurance companies. Typically, that new debt is issued to and sold to existing bond market participants. Now, monetary financing would involve the central bank coming into the market to buy new issues of debt. Some people are saying, is this happening in 2020? Here's an article from Adair Turner and Project Syndicate. In response to the COVID-19 pandemic, the USA's Federal Reserve, their central bank, will buy unlimited quantities of Treasury bonds. The Bank of England will purchase £200 billion of gilts. And the European Central Bank, the ECB, up to 750 billion of Eurozone bonds. Almost certainly central banks will end up providing monetary finance to fund fiscal deficits. Some economists effectively call this a form of helicopter money, that central banks are essentially giving governments, if you like, an unlimited overdraft facility to spend during a time of economic crisis. So what's the process by which monetary financing happens? Let's start off, for example, with the government increasing their spending to run a bigger fiscal deficit. They might be, for example, putting money, £4 or £5 billion into a job subsidy program, or perhaps an infrastructure project. Now, normally that's financed by the issue of new debt to the bond market, and that debt has a yield. The yield is determined at the auction when the debt is issued. It's determined by the price of the debt, and that then determines the yield. So it's normally financed by issuing new debt to the market. However, with monetary financing, the central bank might commit to buying some or all of this new debt. Effectively, that is a transfer of money created by the central bank to the government, and therefore that increases the base supply of money in the economy. Now, what are the justifications for this monetary financing? Well, the first one essentially is that at times of major economic crisis, and I think we can say the COVID-19 pandemic and subsequent recession is a really important moment for the economy. The direct financing of new government debt might be justified as a way of funding essential infrastructure projects or other forms of fiscal stimulus. Increasing the money supply through this means is a way of warding off, preventing, reducing the threat of a major deflationary depression, the economic and social costs of which can be extremely severe. And the justification is also added to by saying that the risk of inflation from doing this is relatively low in a recession, in a depression, particularly when private sector demand from households and businesses is fairly weak. The argument runs essentially that if you're going to use monetary financing, this is the time to use it because of the depth of the downturn in the economy, the risk of mass unemployment, and the fear of deflation. On the other hand, of course, there are critics of monetary financing. There are people putting forward the opposite view, saying there are significant risks, potentially big drawbacks from this kind of strategy. And the biggest fear is that increasing the base supply of money by the central bank essentially creating this money to buy the debt will eventually lead to a steep rise in inflation. And of course, some people think hyperinflation is round the corner. Now, if inflation goes up, it's effectively a tax on us, because if inflation goes up, the prices of goods and services rise, our real incomes, our ability to buy goods and services goes down. Inflation effectively is like a new tax on households. And of course, some people point to monetary financing associated with disastrous economic and social consequences in countries such as Zimbabwe and Venezuela and Weimar Germany in the late 1920s. The second main argument is that if a central bank is always ready to fund effectively new debt, then there's very little political discipline, very little market discipline on government borrowing. Essentially, government can spend what it wants if the central bank is there ready to fund it. And that could lead to an increase in irresponsible spending, an increase in public sector debt, the risk of government failure at a macroeconomic level, because governments effectively can spend without necessarily having to justify every dollar, every pound of spending they put on the table. So those are some of the arguments for and against. The UK government's response to the crisis has been a big rise in government spending. Some people are saying that the government may borrow more than £300 billion in this financial year. National debt is bigger than GDP for the first time since the 1960s. How is this all going to be financed? I think it's definitely worth knowing something about monetary financing as part of your study of monetary and fiscal policy. Okay, thank you very much indeed.